This episode of Willow Oak's Value Hour features thoughts and commentary from our affiliated managers in our annual Willow Oak Roundtable discussion. Joining us today are Stephen Keel, Keith Smith, Dave Waters, and Sri Viswanathan. Stephen Keel serves as portfolio manager for Arquitos Capital, where he manages an unusual portfolio, investing in special companies going through unique circumstances. Steve launched Arquitos Capital in 2012 and serves as the president of Willow Oak Asset Management. Keith Smith is the portfolio manager for the Bonhoeffer Fund, which invests across market sectors and geographies, finding capital-light businesses with recurring revenue streams that offer long-term value. Keith is a corporate valuation expert and CFA and co-launched Bonhoeffer Fund in 2017. Dave Waters is the principal of Alluvial Capital, managing capital through a private partnership and separately managed accounts. Alluvial invests in little-known and often underestimated companies domestically and internationally. Dave is a certified financial advisor and launched Alluvial Capital in 2014. Sri Viswanathan is the principal of SVN Capital. SVN invests in a handful of quality businesses across geographies that are carefully selected and patiently held to create wealth. Sri is a CFA and CPA with more than 2 decades of experience in corporate banking and portfolio management. He founded SVN Capital in 2018. Welcome, gentlemen. Thank you so much for joining us for this special Roundtable Value Hour edition. Thanks to Steve for practicing social distancing to the utmost. Sri, Dave, Keith, thank you all for being here. I just want to first and foremost offer each and every one of you a hearty congratulations for making it through a very tumultuous year, replete with dramatic ups and downs. 2020 certainly offered numerous insights and takeaways worthy of discussion. So let's get to it. My first question really is for all of you. Would love to hear your thoughts. Dave, I'll kick it over to you though. So basically, as investors with a long-term focus, a very rich history of experience behind you, and a long runway in front of you, how will you be talking about having been a portfolio manager in 2020 in, say, 10 years?
Thanks, Jessica. I guess, first of all, I would say that it was a year full of opportunities. And that's not unlike any other year. I think when we look back on 2020, and hopefully where the world and the economy and everything is in a better place 5 to 10 years down the road, but we're not the first investors to have gone through a very difficult time in history or a very difficult economy. I mean, nothing in human history is new. There's always been plagues and wars and famines and strife and conflict, and hopefully there's less as time goes on, but it's part of human nature. And so I think any investor who is completely taken aback and totally surprised that bad things can happen was being a little bit naive. And that's an important aspect of portfolio construction. To always be thinking, well, what happens if such and such goes wrong? And 2020 was a year where a lot went wrong. We're not through the woods here on COVID, and hopefully 2021 has better things for us. But if you look back at the performance of the various economies and industries and sectors in 2020, there were obviously sectors of the economy and the market that were terribly affected by COVID-19, that were devastated. And there were others that were massive beneficiaries. And any investor who just saw the headlines and saw the market plunging in March and outright panicked probably had a very difficult time for the rest of the year. Whereas anyone who looked at it as an opportunity, a time to do the extra analysis, do the extra thinking, and keep one's wits about them, probably wound up making a few great investments during that very, very difficult period. And every year has something like that, where the market gets fixated on short-term headlines, or some kind of risk is causing waves in a particular part of the market or the entire market. And you can look at it and you can panic and you can let fear overtake your decision-making process, or you can figure out how to react in the best way. And I hope that after this year, and with the benefit of a couple years of introspection, in hindsight, we can all say that this away from this year a better investor than I went in, and ideally can point to a few decisions we made that ended up being really, really beneficial for everyone.
Yeah, and I don't think anyone would have expected here we're in January 2021, last March, that we'd still have to be wearing these, but here we are, and it'll be like this for some time. When you look back during this time period, there are certain years that everybody remembers. And before my time, people would talk about the 70s and inflation era and how investing was during that time period. And then 1987 and October crash was seared in people's brains. And more from my era, you had the tech bubble in that time period. And then, you had the real estate bubble and the crash of '08. And now this is where we are again. These are memories that we'll be talking about and thinking about. People will be scarred with it on the negative side, and some people will view it as an ultimate great opportunity on the positive side when you look forward 10 or 12 or 15 or 20 years. These are the time periods that are remembered. When you look in the history books, they'll say 2020, they'll say 2008, they'll say 1999 to '01, they'll say 1987, and they'll remember this in the same vein. So it's a very interesting time. This is a great learning opportunity for all of us, especially retail investors, and I'm afraid some of them may be learning the wrong lessons, unfortunately, but there'll be consequences to that. That's why it's valuable now, I think, active management who is sober, fundamental, take a fundamental approach, and more conservative in nature, which I think all of us are. I think this is the time for us over the next 2 years to really differentiate ourselves through the portfolio with that approach. So I'm cautious on the market as a whole. I'm worried that the wrong lessons were learned by the less experienced investors. And, it's an unfortunate thing, but those things happen and ultimately will be the beneficiaries of that. I think it was Buffett, or he might have paraphrased someone else, that basically the stock market is a mechanism to exchange wealth from the impatient to the patient. And I think we're all patient, fundamental, bottom-up investors here. And that's where I'd like to be in the near term and midterm.
Yeah, I mean, I echo Steve and Dave's comments here. I really think this is it's gonna be an interesting time. I think the main thing that I've seen going through this is that the value of deeper fundamental research is really going to be shining. I think a lot of the quantitative strategies have had some issues this past year, and a lot of times the quantitative strategies are based upon relatively simple ratios and multiples and such like that. And I'm not sure whether I think that's going to change going forward. I think the market has gotten smarter in regarding to looking at, specific companies, just not buying them because they're cheap, but looking at what's behind them. One of the things I think that I've sort of tried to dig into, I think a lot of other investors have sort of re-examined the value of growth. I mean, growth clearly has, in some portions of the market, has really taken off. And so I think every investor needs to step back and sort of say, okay, how does growth fit into my investment process or valuation framework? Because completely ignoring growth, or basically downplaying, or not having, not really having any stocks that are growing very much, clearly hurt this past year, and I think it will probably continue going forward. So it's basically trying to incorporate some of that growth aspect into markets. Now, there's different ways to do it. I mean, one way I find somewhat interesting is you can take some stocks or segments of markets. You can, even though the market may not be growing, there are certain sort of consolidation plays and fragmented markets that really can add some value there too. So your market doesn't necessarily have to grow, but you can just get a larger share. There's another way to look at it and get growth in a reasonable way also. So those are some, I think, some of the things looking back on it 10 years from now, it's going to be, okay, well, at least for me, and probably I've heard this from other managers too, is just re-examining their process and the way they look at things, and what sort of new tools have they sort of incorporated into their toolbox and the way they look at markets and valuation.
So, as a new guy under this wonderful Willow Oak umbrella, let me first of all wish you all a fantastic 2021. And with respect to the question about looking back 10 years from now, I'm reminded of the quote by Harry Truman, who said, there is nothing new in this world except the history that we do not know. And so, as Dave mentioned, we've been through so many cycles. In fact, just last night I was reading a fantastic biography on Buffett by Roger Lowenstein, Making of an American Capitalist. And it sort of details back in 1968. You had the political unrest. You had, assassinations as well, but the market was ripping, just as it has done in 2020. So to Dave's point, yes, we've been through cycles like this, and I'm glad that I'm going through, or I have gone through this masterclass in long-term investing. And looking back 10 years from now, I'm going to be delighted that I've gone through one more cycle. I'm glad to say that I've gone through 3 cycles in my investing career. To have more cycles under my belt is only going to give me the patience to kind of continue to stick with my investment style and look for opportunities, as Steve mentioned. So that's what my 10-year look back would be like.
Great. Keith, you mentioned kind of reevaluating the tools in your toolkit. Question for everybody, but maybe Keith, you can kick it off. Were there any affirmations or adjustments to your investment philosophy or process as a result of this extraordinary year that you'll be carrying forward that you could speak to?
I mean, I think for me, one of the things I've taken a look at is going back and taking a look at what are the drivers of growth in some of these businesses and industries. And then from that, looking at, okay, one of the areas I think that's interesting to look at for opportunities is fragmented markets where companies can make accretive acquisitions going forward and get synergies associated with those. Looking at those kind of businesses and sort of seeing what's going on. I mean, I think a very interesting change, especially in a lot of retail type businesses, is the internet has opened up a new channel. So basically you have more fragmentation, but the real question is, when it comes to some of these businesses, is will the bricks and mortar guys be able to actually, be able to capture that, or are the online sort of disruptors going to capture it? And there's going to be a very interesting sort of struggle there. In some businesses, some retail aspects, having an omni-channel approach is much better than having either an online or an offline only channel approach, especially in some businesses where you can where basically you can reduce the cost of delivery in some items, just because, let's say, the cost of the item you're buying, delivery is a very large portion of that. One way you can overcome that is by, for example, in some firms basically saying, okay, you can order it online but pick it up in the store. Those type of situations, and in those cases, the incumbents are really going to do well. And the disruptors coming in having an online only model are clearly going to be at a disadvantage, because they have to basically deliver the product to the customer, but it's going to cost them more money. But the in-person presence provides that, in addition to situations where in-person presence actually can create more sales. So for example, if you look at companies that, I'll give an example here of a company that sort of is along those lines, is Michaels. Michaels is a company where it's an arts and craft company. Basically, the consultative sale approach of someone coming in with an idea in their head of what they want to make, that interaction is very important. You can do it online, but I think there's a lot of value add. And then you've got management teams, like the management teams at Michaels, rejiggering their processes to basically allow more time for associates in the store to have those kind of interactions. So they've tried to really so you've got that kind of innovation happening in some of the bricks and mortar, I think, businesses, which, on the surface, people may say, oh, okay, well, it's everyone's going to be eaten by the internet. But I think there's some real interesting, when you look at some of the details, there's some real interesting aspects of what's going on there. So for me, a lot of it's been just sort of thinking through that, and then just talking and collecting information on what's going on with these various businesses. In car dealerships, the same sort of thing, versus Carvana and some of the other sort of players in the market there too. So it's a very interesting, I think, time to sort of look at that kind of stuff, but it requires much more deep understanding of what's going on. That, like, for example, we talked about some of the quantitative stuff before. You're not going to see that in a price to sales ratio. You're not going to see that in the EV to EBITDA multiple. But you're only going to see it by qualitatively understanding what's going on, which I think is something that a real person managing the money can do versus more of a quantitative approach where that's not going to be reflected there.
I mean, this is the year, I think, where the word platform, 2020 was the year where the word platform really took off. You know, if you could change the name of the company to include something with the word platform, you might get a higher valuation today, sort of like how you would get .com in the late 90s, or, you know, turn it to some sort of space-oriented thing in the 60s. And it goes to show, you know, when you're looking at TAMs, and those things don't show up in the current analysis. It takes active management. It takes qualitative thought process related to it to understand the value there. And sometimes when we look at companies that have exorbitant price to sales, or they have no earnings as of yet, and as more traditional value investors think that's insane, some of these companies have really grown into that, and it's shown to be a great investment with tremendous growth potential, because all of those early losses were essentially capitalized expenses. And it's different today than what it was before, where you had to put out a certain amount of money to build a railroad line, for example, and all of that was capitalized. Today, a lot of those startup expenses are not capitalized, they're expensed. And if they can hit in an area where that total addressable market is massive, there's tremendous opportunity there, and things can change very quickly. And we've seen that really over the last 15 years, but it's accelerated, I think, this past year because of all of us kind of working from home and having that network effect. And so that's one thing that I concur with Keith. And I think other thing for me was just the speed of change. I don't think anybody expected in March and early April, when things dropped so quickly, for it to hit a bottom so quickly. You know, when you look back at 07, 08, 09, there was a 6-month time period. You know, look, you had a beginning of 08 is when you first had problems in the markets. Late 08 was when the crash really occurred, and the bottom didn't occur until, I believe it was March 09. So you had a long time period to react, to put as portfolio managers, and to put money to work or to take it off the table. Here, the market crashed very quickly and then recovered very quickly. And I think a lot of us might have been caught up in that. There were things on the watch list we liked. There were concerns perhaps about current holdings that caused us to sell out when the prices were low and the stock prices were low, and we missed some of that uptake. And, you know, that's kind of the nature of, I don't know, maybe it's because it's 2020, 2021, and things are different. Things move a lot faster. The Fed moves a lot faster. The government, you know, moves a lot faster. And they did, at least in this year, of issuing checks. I don't think you could say the same thing about the vaccine rollout. But these things happen in a way that they were not happening previously. And we have to adjust to that. And I think that's a takeaway for me, is some of those things on the watch list, or some of the things we own, we just have to make decisions and move a little bit quicker than we otherwise would have had in the past.
I mean, one of the interesting things about this recovery also is that the recovery it didn't really get into the banks very much. If you look at a lot of the past sort of declines that's gotten into the banking system, the finance, the housing crisis, et cetera. Once a boom and bust gets into the banking system, it typically takes a longer period of time for the banking system to recover. And in this case, what happened was there wasn't a whole lot of leverage in the system, and the leverage that was there was a lot of it was equity. So, you know, there wasn't a massive loss. When you're dealing with a debt issue, you end up with people that are underwater, and that sort of stagnates the system for a little while. It takes it longer to recover. So I think in this case, it's a little bit different from that perspective. But going in, it was, you know, there still was some down, you know, a good sized downdraft with a very interesting, bounce up afterwards.
On that point, Keith, don't you think it is we're just a little early to really conclude that the banks don't have a problem, because there's obviously commercial real estate and a bunch of other businesses that are still struggling, waiting for PPP or other loans for them to actually fund. So yes, the credit loss is going to be deferred for a little bit, but I'm not sure if I'm willing to jump in and say banks are completely out of the water. We may see the credit risk come back maybe with a little bit of a delay compared to what we saw in '08.
No, I agree, but I think that the bigger difference is that in '08, what happened was that there was a large bubble beforehand. In this case, there probably was not a largest bubble. Once the bubble popped, there was a lot of leverage that was basically knocking things down really quick, and you had a lot of knockoff effects. So what you actually had in some cases where sectors that weren't affected at all were actually being punished because of leverage that people had somewhere else. So there's a lot of interconnected leverage. I think the U.S. and other players at this point have done a really good job being scared of that in that recession of removing a lot of the interconnected leverage. So even though leverage is there, and like you're saying, there's going to be losses, I don't see it anywhere near as interconnected, and that's sort of what probably ties 2008 and 1929 together more than any of the other two sort of declines of this type, is the fact that the interconnected leverage, because I mean, what's really dangerous about that is you don't know where the connections are, and one thing hits something else, and it just sort of creates a snowball. And when enough of that stuff happens over a longer period of time, people start losing confidence in the system. In this case, since there wasn't a whole lot of that, I think confidence was able to be re-established relatively quickly, because people weren't concerned about another shoe falling like they were, I think, in '08 and then '29. At least that's my, I agree with you. There's still issues there, but it doesn't seem to be as interconnected or as levered as it was in those previous recessions.
If we stay in the finance area, but maybe go on the peripheral of banks, I'd be interested in, this is kind of a combination, this for Dave, if we combine the network effects of some asset managers and the growth associated with it. Dave had a huge win this year with P10 Holdings. It's nice to talk about a few stocks here, and we should pat him on the back for his success there. What was the thesis there, and will that continue to hold up and have the same kind of growth potential going forward?
Well, thanks. I'll take the congratulations. It's nice to have a win now and then, especially as it's been a little bit challenging past couple of years in the more traditional sort of value investing arena. But essentially, now and then you find a company that not only is cheap based on its current rate of earnings or cash flow, what have you, but also has the opportunity to reinvest that cash flow for years and years to come at very attractive rates of return. And this is not revolutionary. I'm certainly not the first person to have this sort of insight or thought about a company, but you don't often find this sort of company when it's so small. Typically, by the time a company has both the financial ability and the management team in place to make those sort of deals and have that credibility in the market, they're much larger and they've been around for a number of years. And this was a different case where a bankrupt company was recapitalized by a couple of smart people who then had the connections and the wherewithal to do the deals they needed to do to really build something. And I mean, I kind of feel like we're still in the early chapters here. Just talking about alternative investments more broadly, I think the trend for several years has been away from investment in public equities by large institutions and endowments and pensions, things of that nature, and more toward investments in private assets, whether it's private credit or private equity, and then you have on that top of that, you have the emerging trend of socially conscious investing through ESG. It's just going to become a bigger and more attractive thing for a lot of large pools of capital. I think over the past few years, some large investors have said, you know what, the equity markets are more and more looking like massive volatility for not a terribly attractive return stream compared to the returns on offer and in private equity or private credit or what have you, or infrastructure for that matter, for low volatility cash flow streams. And the people positioned to capitalize on that, the asset managers there, are the beneficiaries in terms of gigantic flows of assets under management. And they're in a great place. They don't have to do a whole lot of marketing to get a lot of inbound attention. And so that's been a wonderful thing for them. Yeah, I'm very, very optimistic on the entire alternative investment space, because I think what a lot of, like I said, a lot of institutions have said, is it really, really worth my while to own the S&P 500 index that might be up or down 30% in a year, where I don't need this money now. If I put it in a fund of funds or private equity vehicle, I don't care that I don't have liquidity right now, but in 5 or 10 years, I feel very confident that'll be worth a lot more. I do think a lot of investors are sort of reassessing their liquidity requirements. If you don't need your money in the short term or even the intermediate term, 3, 5 years, put it with someone who can make those long-term investments and really allow for mean reversion or compounding or whatever's going on in those underlying holdings to take place. And maybe I'm a bias as a person who tries to invest like that, much like the rest of you guys here. But I think that's a great thing for people who don't need to access their money tomorrow or next month or next year. But yeah, I continue to be a big believer in P10 and what they're doing, and I expect more great moves this year. But it's always keep my eyes open for the next one as well.
Yeah.
Well, if I could jump in on that to kind of follow up on what Dave said. Yeah, absolutely agree with him on alternative asset managers. I haven't had the P10 kind of return yet, but KKR is a big holding in my portfolio, and very similar theme to what Dave just detailed. Phenomenal asset managers on the private side. They have a public arm as well, growing internationally into several different verticals. We had a big acquisition in annuities, taking the total assets from about 220 billion to close to 300, and great management team, big insider ownership, and but bringing it back to the operational aspect very much highlights what Dave just mentioned.
I mean, I think that just goes to show, and we can kick it back to the next question, that you can take a barbell approach here, because when Dave first got involved with P10, it's still a small company, but it was tiny. And Shri, I think I agree with him on the KKR position as well. Obviously a massive company, but still had some, and has experienced this the last couple of years as well, just tremendous potential over the long term in a company that's been around for a long time. So, you can, I think that's actually where I would rather be on one side or the other, or both, more than I would want to be into a mid-sized company in that same situation, given the current environment.
Great. So Steve, maybe I'll kick this one over to you. How would you characterize value investing today, and has it changed in the recent past?
I don't think the definition really has any meaning anymore, quite frankly, because traditionally you would say, well, value investing is kind of a balance sheet oriented subject. It was a Ben Graham style approach, where first you analyze the balance sheet and then went from there. It morphed over time into kind of a combination of value and growth, where you can consider some sort of value about the future, whatever your estimate of the future valuation of the company would be on the income statement side. And at this point, I think we should just throw the word out, quite frankly, and say, look, we're bottom-up fundamental investors who take a qualitative view on things while still recognizing and appreciating the quantitative factors. And I think in a world of euphoria, where people, especially retail investors, most inexperienced, just hop on the internet and make a trade, barely knowing anything of the financials of the company, and investing on a theme of the company, that's kind of part of the competition there today. And so I think at this point, I would probably define value investing simply as fundamental investing.
I mean, I agree with Steve. I mean, I think there's a lot of that that's in essence sort of what's happened. I really like to think more of value investing as more of just an approach of buying something for less than what you think it's worth. Now, one thing I think that's changed is you need to incorporate growth into what you think it's worth, and rather as opposed to some of the other sort of techniques that Steve had said that are maybe more speculative in nature, buying on a theme, momentum, those kinds of things, which work more in the short term. It's just, I think the difference that I've seen is that there's a very large difference in being able to qualitatively assess and come up with what you think is a reasonable growth prospect versus just getting a low PE stock from a screen. And so, I mean, I think to a certain extent, maybe value investing's gotten a bad name because people have this thing called the value factor, that it's basically a low priced company coming out of the screen. But I really don't even call that investing. That's just running a screen. I mean, I don't know.
Yeah, I'd say value investing as concept, of course, is alive and well, but what it looks like will change over time. And I think part of that is because what the market underprices can change over time. I think there was a long section of market history where the market systematically underpriced the value of earnings, current earnings, and underpriced the value of balance sheet assets. And that resulted in significant outperformance for a long time for companies that had a low P multiple or low price to tangible book value or hidden assets of some nature. But I think generally people got wise to that. But then the next thing the market began to undervalue was growth opportunities or economies of scale or the potential to become a platform. And that, of course, has been more and more recognized over the market over the past several years, to the point where potentially that is becoming overpriced at some point. Now, the quest for forward-thinking investors is to figure out, okay, well, what will the market undervalue next? Will it be a return to historical times where investors suddenly come back to realizing the importance of current cash flow and the importance of a strong balance sheet? Maybe, or maybe it will be something entirely different. And that's the task for the analysts to pursue.
No, I agree. The underlying part of the question that is not explicitly asked is value investing versus growth. And I just don't know if there is any value in sort of discerning the difference between those two. Yeah, as Steve mentioned, the historical definition of value investing is buying something cheap relative to earnings or book or some sort of EBITDA multiple. And that's gotten confused with the true definition of value investing, which is buying something cheap relative to intrinsic value. And that part of it hasn't changed. You're still looking at cash flow into the future, discounting it at an appropriate rate. But it's certainly a hot topic. In fact, just yesterday or a couple of days ago, Howard Marks released his latest missive titled "Something of Value." Even Howard Marks, a big credit investor, is having difficulty accepting what's happening in the market today. And so he's sitting down with his son, Andrew, who's a classic growth investor in the definition of growth, and having a very frank dialogue on what investing is. And hats off to him. Hats off to Howard for having the guts to kind of come out and talk about how much he knows and how much he doesn't. And so I don't have anything else to add except say that the distinction between the two do not really make sense.
So let's switch gears just a little bit and look forward a little bit. Any sectors you guys are more or less interested in, given the landscape for investing in 2021? And then similar, any opportunities in specific countries or regions? I'll throw it out to the group, but maybe Keith, you'd like to start?
Sure. I mean, areas I think that are interesting, that I think have some interesting growth potential, are primarily sort of these fragmented markets, the ones where there's no large competitor, or they're in the process of trying to put one together. A lot of these are in distribution businesses, probably one that's around the world that people is most familiar with would be like auto dealers. And that's a very interesting market in the fact that the largest auto dealers in the United States, the largest one has about 2.5% share. The top 5 have maybe like 8%. So you've got a market that in essence is a very fragmented market. They're being rolled up, but the internet has basically catapulted these businesses to be I think to consolidate a lot quicker. You look at some of the earning growth prospects of these businesses, historically, they've grown maybe 10% by a combination of a small, single same store growth at dealerships of maybe 3%, and then you get 7% with acquisitions. But right now, a lot of the companies in the space are looking at 10% growth on the internet. And what the internet really provides for auto dealers is it allows them to reach consumers outside of their geographic footprint. So if you can incorporate the internet into your model, you can sell a car anywhere in the United States. And some of these guys have put together models to be able to do that. So that's an example of an industry that at this point is still very, very fragmented, consolidating, and has some real interesting opportunities. I think what's happened is the market is pricing those businesses as though historically they have, which is pretty modest, and not really incorporating some of the growth. So, for example, if some of this growth can happen, there's companies out there that say they can get 20% sort of earnings or cash flow growth over the next 5 years. Well, most of these companies are selling in the low teens earnings multiple sort of range at this point. And so if they achieve that 20% earnings growth over the next 5 years as this business consolidates, I mean, you're going to have a huge win there. I mean, because clearly they're going to be valued more than that if they're growing at that level. And the growth itself in 5 years will probably double the size of the business or more, and it'll be on a higher multiple. So you'll get a situation similar to, Davis put together a book where they call this the Davis double, where you try to find industries that are selling at modest multiples today that have some really good growth potential. So you really get two things happening at once. You get a higher amount of earnings plus a higher earnings multiple. And since they're multiplicative, if you get a double in a multiple and double in earnings, you get 4 times upside in the stock. So I think there's industries like that. I mean, there's some of that stuff in retailing also. So that's really what's been interesting to me, is to look at these sort of fragmented industries, and is there a way that you can get this type of growth in these businesses going forward, in the market not really sort of capturing that in the current multiples that are out there. So I think for me, that's sort of one area that I've looked at that I think is interested. And I think it's probably applicable to a lot of fragmented businesses, but there's a lot of fragmented businesses out there. But what happens a lot of times is a lot of them are selling for relatively high multiples. If you find one with modest multiples where the growth story is supportable and you think makes sense, I think it's an interesting way to play some of the. So it's an interesting, I think at this point, opportunity for investors. And the thing with this opportunity, it's around the world too. It's not just in the U.S. There's UK, there's dealerships around the world, so it's an international opportunity. It's also available here. So in my mind, I think that in terms of countries and stuff like that, it's primarily stuff's going on in the U.S., but I think there's some international opportunities in that particular space also in the UK. There's some opportunities in South Africa and other places like that, where in essence it's the same thing happening, but it's happening, around the world from that perspective.
I mean, I'd like to hear, I'm going to defer here to Sri and Dave, but I'd love to hear about some of the things that you're finding in Poland and other areas that you've discussed previously.
Yeah. To follow up on what Keith just mentioned, I'd say the epicenter of what we have just gone through in 2020 has impact is primarily located in travel and everything to do with travel, right? So one of the companies I have in the portfolio is Intercontinental Hotels. It was a position in the portfolio beginning in late 2019. But the primary thesis actually has become even more attractive. In fact, right after the pandemic hit the scene in the United States, there was an interview in which Bill Miller participated, and he said, if you're not investing in airlines, this was right after Warren Buffett had famously exited all his airline investments, and he said, if you're not investing in travel or airlines, you're not investing in vaccines. I absolutely agree with that. So Intercontinental Hotels is one of the largest hotel groups, 18 million rooms around the world. Top 6 brands essentially have less than 40% of the total market. But my thesis was before the financial crisis hit, because of the China tariff issues imposed by the Trump administration, IAG's China business was not doing that well, and that was my primary thesis. But into 2020 and looking forward, I think travel is going to be an important area of growth, including business travel. In fact, when I listened to Arnie Sorensen of Marriott, Hilton CEO, all of them seem to think that business travel will be a little slow, but it's definitely coming back. And given my investment style of looking forward over the next 7 to 10 years, I absolutely think travel is going to be an important area of growth looking forward. Another name of the portfolio is a company called HEICO. One of the segments is actually focused on commercial airlines. They provide replacement parts for commercial airline operators, and because of commercial travel having come to a screeching halt, that business has been negatively impacted. But there again, I think that's going to be an area of growth looking forward. To answer Steve's question about Poland, yeah, I do have a position in a company called LiveChat Software, but Poland as a market is, I think, underappreciated. I think there are some very positive trends. As I mentioned the last time around, it's an economy that has not suffered a recession since the late 80s, since the early 80s actually, up until COVID hit the scene in March. A very well-educated population base, particularly with a focus on technology, and they have specialized in developing talent towards gaming, video gaming. A balance sheet that is much better than many of the other European peers. It's part of the EU, but it's not in the Eurozone, and so they have destiny over their own currency, Zloty, which actually has held up fairly well. And they also have this potentially a powerful force coming from the pension program called PPK. And so my investment in LiveChat is not because of the macro top-down view, but I do like what I see in the local market. In the same vein, the other market that I think is well poised, but valuations are a little closer to nosebleed territory, is Australia. We can go into it at a later point if there's more interest, but those are the couple of markets that I see somewhat more attractive. The third market I would highlight here is UK. Given the Brexit and the third lockdown, I think the UK market has definitely a lot more opportunities to offer. My investment in the Intercontinental Hotels is actually listed in London, even though IAG is also listed in New York.
Good insights. Always enjoy hearing more about Poland. I remember looking at LiveChat software a couple of years ago, and it's officially got away. So congrats to you for seeing that investment and pouncing on that. It's a wonderful company. Similarly, Europe has been a very fruitful hunting ground for me. I've had a lot of fun looking at Italy in particular. I think Italy, probably like maybe France or Spain, suffers from the investor perception of very low growth, highly bureaucratic, not a lot of innovation or anything going on. But I've really found that not to be the case, especially at small companies. In one particular industry I'm extremely bullish about over this next several decades is communications infrastructure. I really feel that expanding access to century version of electrification that took place in the 20th century. It's really, there's no participation in the modern economy without access to broadband, and Italy has the lowest broadband penetration of any developed European economy. And they're working very, very hard to change that. And there are a few small fiber operators over there that I've invested in, and have been very happy with their results and expect a lot more going forward. The economics of the industry are really very compelling. So essentially, you run a fiber line through a new neighborhood, you get some people to sign up, you get a return on your investment, great. However, the incremental margins, the incremental returns from additional customers signing on over time is just phenomenal. There's just a couple €100 cost involved in getting a new household attached to your backbone, and then it's pure profit. 80, 85%, 90% of their revenue goes directly to your operating income because the incremental cost for servicing that new customer is almost zero, just a little bit of administrative stuff. And beyond that, so there's tremendous operating leverage, and you can see that if you look at the year-over-year margins for companies like Intred, which is a big holding of mine in Italy. And I think that just continues. Going on top of that, the Italian government is very wisely focused on getting these companies to collaborate and to sign agreements with large continental pools of capital to fund infrastructure development. So Intred and my other holding have both recently signed agreements to be the first developer to put fiber into new areas, and to do so using largely not their own balance sheet. They're contributing only a minority of cost to the entire project, and the large continental infrastructure funds do the rest. And in return, they have the right to be the operator and maintain the infrastructure, and be the first to offer their services on the new network, which is a major first mover advantage there. So yeah, globally, I love broadband. I think it only gets more and more essential. And sure, there are some outside new competitors such as Starlink and a couple other satellite providers, but I really only see that as a threat to incumbents in the most rural areas where fiber and even wireless access are the least economic.
Yeah, I mean, I echo Dave's comments on the broadband stuff. There's actually some interesting potential projects here in the United States from some companies. There's one in particular, I think Consolidated Communications, that's rolling out a large project in northern New England that has similar sorts of dynamics. So I think that's a key piece. The nice thing about these businesses is they have basically few competitors. The other area that I continue to find interesting is South Korea. This year we've had a pretty good investment in some of these holding company transactions. From a special situation perspective, some of those have turned out pretty well. We've had one company that's gone up. I mean, we've ended up selling it. We'll sort of see what happens after it now, but it's a company that went through this holding company transaction where going into the transaction, we held the preferred shares of the company. What had happened was the preferred shares went up about 150, 200%. We ended up selling afterwards. It still did relatively well, but in the same company was able to do that a number of times in the past, once in the fund and once with my private investments. But I think Korea continues to have a lot of these special situations. But in addition to that, some of the underlying aspects of these screen businesses are still there. There seems to be a very large amount of spin-off activity. A lot of companies are restructuring. I was surprised a large one, a holding of ours is LG Corp. They're going through a restructuring, even the larger businesses, and it seems to be, the government has encouraged that, and it seems to be a continuing, ongoing kind of situation. And the nice thing about these things, when there's a number of them out there, you can sort of pick and choose which ones you think are the best and invest some capital there. And that's what we've been doing recently over this past year in Korea. But I think there continues to be some very interesting opportunities because of the dynamics of the Korean market and the fact that a lot of the businesses over there are conglomerates like they were in the United States in the 70s and 80s. And now they're going through this process of rationalization and spinning off. And there's a lot more incentives for companies to do that now and to really focus on economic value added as opposed to, family prestige and just having the businesses being big from that perspective. That seems to be downplayed to a certain extent. So I think there's a lot of really interesting things out there in Korea at this point. And I think overseas, I think it's a very interesting place. I mean, one thing that I've noticed in some of these markets, especially we can use auto dealers as a quick example here, is that the auto dealers recovered in China first. They basically, at this point in the United States, they've recovered and gone up probably about 50 to 60% in the United States. The ones in England are probably about or down a little bit, and then the ones in South Africa are down significantly. So I think what we'll see is over time is as these economies recover, each of these, it'll sort of flood across the world to different places, the recovery at different periods of time as different portions of the world deal with this coronavirus recovery.
Great. A lot of really compelling opportunities to be excited about, certainly. So what types of risks then are you guys assessing in the current environment, both for the economy as a whole and for the markets?
I mean, there's more uncertainty now than there's been in a long, long time. And just because the markets have recovered and expanded considerably, I think we're starting to deviate then from what the underlying economics look for some of these companies and the economy as a whole. I agree and subscribe to Shree's snapback theory on the travel sector. But that being said, there's still a lot of recovery from this year that needs to happen. And going across the board, the world will be a little bit of a different place. We don't know how much we'll be working from home. We don't know how much the commercial real estate sector is going to be affected over the next few years. We know it's going to be heavily affected, though, and already has been. To the discussion we had earlier about banks and the ramifications there, thank God they were in a strong capital situation coming into this, because that would be a major problem. We would have major problems if that wasn't the case. So there's a great amount of uncertainty. I'm cautious, certainly in the economy as a whole, and eventually that does get to the markets. And I think what'll happen is we'll get some analyst estimates over the next 6 months or so for next year and for the year after, post-COVID estimates, and the reality will start to set in a little bit. I think I'm probably positioned a little more defensively and in some certain niches that won't be affected by that because of that thought process.
I mean, I think areas to be cautious about will probably be ones that are more capital intensive, like real estate, as Steve had mentioned, especially areas with declining demand and a lot of leverage. And I think that's the potential issue with some of the real estate plays, and the fact that if demand for office space has gone down and you're invested in a leveraged REIT, the demand is going down. You've got leverage. That's usually not a very good story in terms of what goes on, and it takes a while for that stuff to turn around. So I think, in my mind, that's where I see the risk. There's also some very interesting opportunities going on. You have record savings accounts. People have record cash balances to spend. So one area I think is interesting is the continued consumer parts, certain types of consumers. Clearly, the restaurants and some of these other more leisure activities have really been hit hard. But on the other side of the coin, you do have a lot of money saved up and a lot of pent up demand. And once people are vaccinated, people will probably start to spend that large amount that they've saved up. They've paid down debt. I mean, personal balance sheets are probably in the best positions they've been in a long time.
Yeah, I would say, from my standpoint, the three routes to permanent loss of capital, they've remained the same for time infinity. Financial leverage risk, which Keith just mentioned, fundamental business risk. As Steve mentioned, there are a lot of new businesses with no earnings, but a lot of revenue growth. Some of them are not going to make it. And the final risk is valuation risk. Right now, valuation risk seems to be the more important area of focus, at least from my standpoint. I mean, we had a year in 2020, we had the highest number of IPOs, 430 odd IPOs, Almost 66 of them doubled before the end of the year. We had the record number of SPACs. 11 of them doubled before the end of the year. Bitcoin went up 4x before the end of the year. And it actually went up more than 50% in 15 days in December. Clearly, valuation is a little bit out there. From my standpoint, both in my portfolio and Steve, Dave, and Keith for the call here today, we all invest globally, and I think that's a big benefit to creating a portfolio for outperformance over a long stretch of time, because I find valuation outside the U.S. being a little bit more attractive at this point. So I come back to valuation risk being the primary focus. And the other two are important, but from my portfolio standpoint, it's less of an issue, less of an issue.
For sure. I think that a central guiding point for me has long been that anything can happen. So I don't spend a lot of time thinking about the macro economy or which way interest rates or anything like that are going, other than thinking they could go up, they could go down. And so I think it's the job of the investment manager to make sure that our portfolios can, if not thrive, at least not be totally wiped out, even if something totally unexpected happens. I mean, interest rates have had signs of life lately. The 10-year is up. It could keep on going up. If you're holding an entire portfolio full of nothing but companies with huge amounts of debt at variable rates, that could hurt a little bit. Similarly, there's a lot of hope over the vaccine rollout and COVID going away. And I do think that's what will happen, but there's always the chance that a new, more deadly, more contagious strain develops, and that could put an end to that trade too. And so it's important not to have an entire portfolio on things that only work if the economy reopens. So I think that, and that's a lesson I think a lot of investors who have put their portfolio entirely into the most bubbly go-go stocks of the moment might learn the hard way. If you have nothing in your portfolio except tech and Bitcoin and Tesla, you've had a really, really fun year. Your year has been a lot more fun than probably anyone else here. But don't think that it can't change. And similarly, probably some of those of the last year learned the hard way that if, like Keith was mentioning, if nothing in your portfolio has any growth to it, it all has great free cash flow yield, it all has a lot of free cash flow, that sort of thing. That was a great balance sheet, but the revenue is going nowhere. You didn't have a very fun year either, because you didn't catch a lot of the rebound. And so I think that you can have a view, and you should have a view if you think that you have the sufficient information and confidence to back that view up, but don't commit to it so wholeheartedly that if your view doesn't come true, your portfolio just gets wrecked. And so I've tried to put a little bit of everything into my portfolio, not having a strong view about the economy. That's an approach that works for me. And I think unless you have sufficient confidence and information behind you to feel strongly that way, it's better to spread your bets around a little bit.
No, that's a very good comment, Dave. I mean, I think one thing that I've learned through this is to try to diversify the bets a little bit from that perspective, because even though from a long-term perspective, your bets may be correct, you're going to get a lot more volatility if you don't spread them out amongst different types of businesses. If you're just focused, like you're saying, on a deep value kind of thing, the strategy may work out, but you're going to get a lot of volatility along the way. If you can find other equally as cheap companies that have a good amount of growth, then that provides a balance. Because in some years, the really deep value is going to go like crazy, and the growth's just going to thud. It's just a matter of trying to get a combination of the both over time, so your portfolio is really working when the things are down, other ones are going up, so you have a continuous sort of upwards trend as opposed to being so volatile.
That's great. Well, that's a nice segue into the final thoughts. Last question for this segment. What are your most valuable lessons you're walking away from 2020 with, be they investing or otherwise?
I'd say from my standpoint, there are at least two major lessons. One, never mix your politics with investments. Number two, you can never time the market. So time in the market is more important than timing the market.
Yeah.
I would say never underestimate human ingenuity and potential to move quickly in a crisis. I remember that back in February, March of 2020, when everything just seemed horrible and there was no silver lining on any cloud, a lot of people thought this is the end. COVID's going to be around forever. Nearly every business that depends on foot traffic is just done for, and there's no chance it can recover, and like goodbye to the next 5 years. And well, who could have thought at that point that 8 months later we would have not one but multiple extremely effective vaccines? And as much as we'd all like the rollout to be quicker, it is happening, and that's just incredible. It always amazes me how much human knowledge and how incredibly resourceful we can be. And that's why in the long run the economy grows, new technologies happen, people continue to live their lives and have hope because we do things like this. And so it's important to remember that even when things seem the darkest, there are unpredictable but surprising ways that we get through. I mean, that's why we've survived as a species for so long, and hopefully have another couple millennia in us at least. But it's I think that in the long term, betting on pessimism does not pay off in aggregate. Yes, of course, there will always be industries and businesses that succumb to overwhelmingly negative forces that they can't overcome. But I like humanity's chances in the longer term. It's incredible, the advancements and the technology, that it's an incredible engine. And I think if we forget about that, it's to our detriment.
Bouncing off Dave's comments there, Morgan Housel has a good book called The Psychology of Money. And one of the things he talks about in there, and I think other people talked about it too, pessimists always appear to be really smart, but in the end they're wrong. Most of the time they're not right. They sound smart in the short term, but in the long term, as Dave said, due to ingenuity and other sorts of things, and there's been a number of books. I mean, the thesis on long-term investing is called The Triumph of the Optimist. So that in the end, the optimists win. The pessimists may win over a shorter period of time. So from a long-term perspective, I think if you look at just history, there's the recoveries continue to go up, and it continues to we get declines, but then it pops back up, and it's basically just trying to capture those over time and get those as part of your portfolio, which is sort of what wealth creation is all about, is basically being able to, you're basically holding little pieces of these businesses, and you're basically just holding them over the long term. And that's how you can create, that's how wealth is created. And the ability to participate in that wealth creation process in countries like the United States is really awesome. I mean, when you think about it historically, people didn't have access to pieces of the best businesses that are in the world. And today people have that. And the one thing is, if you look back at history, we're in a much better position than we've ever been in history. But you have to sort of, I think if you go through history, you'll sort of see that. And I think that's the perspective that folks have to really sort of go forward with. And it's sort of, I think it makes a lot of sense if you look at history. And I don't think that's going to change. That's one thing I think that's going to be consistent. It's just the continued, innovation, the continued ability of companies to innovate and do well, and people to be adaptable to the situation.
Yeah, well, thank you all for joining us here. I really appreciate the group we have and everyone associated with Willow Oak. Thank you very much to Jessica for hosting and organizing this. You know, I concur with every one of the final comments here. I would just end with the idea that anything can happen. Taleb is right. Black swans happen much more often than how they're tracked, or how often they're tracked. And I think it just pays to have some sort of black swan type hedge in the portfolio. Anything can happen. We've seen it over and over and over again. And as much as we'd like to be able to predict what the next thing will be, we're not going to be able to do that. So thank you all. Jess, thank you for organizing this. Thank you for all your work with Willow Oak. And I'll hand it over to you to close this out.
Yeah, great discussion, gentlemen. Thank you so much for contributing to this special Value Hour episode featuring our Willow Oak Roundtable. Until next year, thank you.
Thank you.
Thank you for joining us for this Value Hour episode featuring Willow Oak's Roundtable discussion. If you are a qualified investor and would like to receive more information on Willow Oak and our affiliated firms, please email Jessica at willowoakfunds.com.